My name is Kai Hoffmann. I'm the CEO of the SOAR Financial Group, and I'm also the CEO of Orion, which is part of that group. I used a very aggressive title for this presentation because I want to make a couple highlights and talk about a few things that are upsetting me in the industry and should help you become a better investor. How your investment is killing the industry is going to be the overall theme of this. We're going to be reviewing some of the data for last year, how the market has been doing, and we're going to do a little forecasting at the end as well. So, in case you haven't heard or who we are, just real quick, a summary. Orion Inc., we're a data analysis company. We track over 1,400 companies on the venture, on the TSX and the CSE. We've tracked over 33,500 deals with our in-house data analysts. We make that data available on our website free of charge. Our criteria, that's really important also when we start talking about numbers later on in the presentation, and it's $1.5 billion in market cap. We track everything below, and financing's below $100 million Canadian. So the index makes Orion Inc. unique. Yes, everybody can track the financings, but we put them in context, and the Orion Inc. index exactly does that. We have three factors that we were weighing the index with. One is the total numbers or total dollars of financings opened, the percentage of broker participation, and the total number of deals open. It's heavily weighted toward the percentage of broker participation of overall dollars raised. But you can see that the overall index, we've been trending up. The purple line is our 5-week moving average. We're coming out with a new index update tomorrow, and we're sending it out to our subscribers free of charge. We're also collaborating with the PDAC for the conference and in general as well. We're issuing a new State of Mineral Finance report early in March, and we'll have a special focus on financing and companies of below $100 million market cap. So stay tuned for that. If you're a subscriber to Orion Inc., you will receive it from us directly. So, I was standing here exactly 1 year ago, making a couple forecasts. These are exactly the terms. I copy and pasted them from my last year's presentation. We talked about flow-throughs will be a major contributor and will keep companies in Canada alive. Cannabis companies have peaked in 2018. We've seen that perfectly happen. And also, we'll see less financings with warrants attached. So I'm going to talk about all these three things real quick before moving on. Fun fact, 2019, the smallest financing was $5,000, and at least got to give them some credit, they raised at 150% premium. So, talk about flow-through. I said flow-through is going to be one of the lifesavers of the industry. It's keeping Canadian companies afloat. 2018, 18.7% of overall dollars raised were flow-through dollars. In 2019, it was pretty much flat, 18.4% as well, $572 million. I hope you can read the numbers on the slides. One thing that's really important, and that might be a little difficult to see, is that the overall percentage of the flow-through dollars as part of the financings for Canadian projects went up from 40% to 47%, meaning flow-through dollars have become even more important than they were in 2018 to have companies explore and develop projects. One thing that's really important to me as well, putting this presentation together, I've seen a lot of flow-through deals that are just embarrassing to the market, and I just want to give you a couple pointers of things to look out for. Pay special attention to flow-through financings that have premiums below 30%, because of all the tax credits, those are easily negligible, and investors get a huge discount on the original financing price. If the financing premiums are negative, that pretty much means that investors are getting free shares. Oftentimes it's company promoters, it's insiders that are getting those shares. Make sure you follow up with a company and ask before you invest who those free shares are going to. And also flow through with a warrant, I think, is a bit overkill. You're getting already a massive discount on the shares. Adding a warrant to that is pretty much atrocious in my opinion. I've taken this quote directly from a press release. If you see that somewhere, where the flow-through units and the non-flow-through units are priced at the same level, don't touch them. Just stay away from that deal. Unless maybe the CEO or one of the directors has a long-term commitment to it, don't even think about buying that. And I urge you as well, we've been getting quite active on Twitter. If you see a deal like that, post the financing news. Junior Mining Network does a great job putting the press releases out. Just retweet it and add hashtag free shares to it. I'm sick of this. I'd love to see a no premium or a 0% premium line. I don't want to see negative premiums or anything else. The rest is just atrocious. You can't read this. I'm going to skip this slide, but it shows the bottom 20 of flow-through financings in terms of financing premiums. Some of the deals have minus 50% flow-through premiums. If you add the 40 to 60% or even 70% if you're in Quebec to those negative premiums, that means investors are getting free shares. And then I made the effort last night actually going through all those companies. They're either scam artists, they're positioning placements for promoters and other investors. You don't want to be part of it. And it's a perfect example of what the industry should not be. So pay close attention. That's why I came up with those pointers. Cannabis is another one that sort of subsided in 2019. The market has become saturated. These are numbers straight from the CSE, as they're the most active market for cannabis financings. And they're as of October 31st. They haven't come out with the last quarter numbers just yet. But as you can see, in 2018, the cannabis companies raised close to $4 billion Canadian on the CSE. And until October 31st, they only raised $2 billion, or it was barely below $2 billion. So that number is dropping, which means other risk capital is more available for mining companies, which is really positive. On the right-hand side, you can also see the MJ index. And that's dropped tremendously. People have been taking money off the table. They got money burning holes in their pocket. Hence, we're seeing a lot more activity in our space, which I'm really positive about, and I'll come to that in a second as well. And of course, lastly, one of my forecasts last year is that we'll see more companies, especially the good ones, reduce the amount of warrants or number of warrants they're giving out. And it's been really gratifying to see that either companies are listening to what I'm saying, or it's just a natural trend that the companies are getting stronger that are out there now. But in 2018, we've seen only 20% of the companies issue no warrant. That's gone up to 25%. That means companies are in a way stronger position to negotiate deals. And I've had a chat with Rick Rule this morning as well. He's not too happy about the development because he's looking for those warrants as an incentive for his investors as well. But I think as an investor in this space, it's a good sign because companies can raise money with less dilution, because those warrants are usually a lid on the stock and don't often help. The other numbers remain pretty much flat, but that no warrant number is a key factor that I wanted to point out. Also, 73.9% of all financings in common shares, I didn't look at flow-through financings, came with the warrant. That's down from 79%. So I see that as a positive development, and things are heading in the right direction here. So, the overall theme, how are your investments killing the industry? It's a very aggressive title, but I want to address a couple issues that I see, and I'm sure it resonates quite well based on the feedback I've received talking about this topic. And you can see this is 2019 numbers. They're all updated. We've only raised $2.5 billion in the category that we're looking at. That is pretty much the lowest level, and we barely beat the really bad year of 2015 in overall capital raised. And I'll come back to this slide with a little more detail later on, but we got saved by the last couple quarters of this year, and I'm even surprised that we surpassed the 2015 numbers. The point is, we got too much competition still. Like, gold itself is nice, but the returns are elsewhere right now. There's no need to diversify your investment. The Dow Jones has gone up year over year, 18, 20%, S&P 25%, the Microsoft, Tesla, I don't even have to read that all to you, but it paints a picture that you don't have to diversify to make good returns, and you don't have to go into higher risk sectors like mining is, same as biotech and venture capital, or tech investments, to make your returns. So ETFs, that's the main issue I have here in the industry. It's an easy way for investors to deploy capital into our space, but it doesn't really help. Because the ETFs don't invest directly into companies. They only buy the stock. Yes, the 70 companies that are in the GDXJ will get a nice lift for every dollar that comes in because it will be directly redeployed by the fund manager, but it doesn't help create shareholder value by putting money into the ground. There are a lot of exploration companies that are starving for capital, and we're looking at roughly $20 billion in capital sitting in these ETFs that are not going into the ground. They're just in the market, and they can easily be taken out of it again without creating any value. If you look at the market caps of the TSX and the TSX Venture market caps as of December 31st were only $19 billion. And if you look at the ETFs in total, and that includes the large caps and the small caps, it's $19 billion. Just the GDXJ itself is $5 billion. And unfortunately, they're not really investing in junior companies because, as Rick Rule said this morning as well, all they're looking for is liquidity at this point. And the GDXJ has companies in there like a Sibanye Gold that has a $26 billion US market cap. That's not a junior. So that money is just misdirected. Yeah, it's fun to invest, and you'll get a nice pop, and I'll have a couple of slides later how much you can make on those, but it's not really helping the industry. And of course, we at Orion Inc., we're looking at the junior mining space, the junior sector. So ETFs do suffocate the juniors. I've ran a couple numbers real quick. Looked at financings below $1 million, 594. That's over half of them are below $1 million, and their combined or average market cap is $9 million. If you look at those, that's insane. Only the larger cap companies can raise significant more money because they're either in the ETF or just more relevant to others. And grassroots companies are struggling for financing. One thing that's a bit putting me off or off-putting, in my opinion, companies always mention, or investors or newsletter writers or gurus say, oh, you should invest into management teams that have a track record. At this rate, you can't even establish a track record. There's no chance. You don't have a chance as a new management team to even raise enough capital to prove yourself. And deal makers, I've been having conversations at conferences where groups that actually have access to capital say, whatever we do, we need to become immediately ETF relevant, otherwise it doesn't make any sense for anything we do because we won't create that interest from the market. One really good example of how ETFs suffocate the juniors is actually Wesdome, and there are others like a Gold Standard Ventures and a First Mining, and having Derek here, he can attest to that, because I think you were at First Mining at the time, is when the rebalance happened in 2017. Wesdome got added to the GDXJ in March. 2 weeks later, it has been announced that they're going to be taken out again, and you can see that perfectly in the chart. It's been really hurtful. Fortunately, Wesdome is a great company, and they recovered. Now they're trading at $9 Canadian, but that's a whole different story. It can suffocate the market. It can take, especially in 2017, a lot of interest out of the market and really hurt a junior. First Mining, unfortunately, and even Gold Standard Ventures haven't really recovered from this pour out of capital. So gold ETFs versus the market. And my point is really you can make decent returns, but there's no need to switch into higher risk capital or allocate your funds into higher risk sectors. The GDX and the GDXJ returned 40% last year. That's great. And we've seen a lot of it happen, as you can see in the charts, late last year. And the S&P generated 25%. Are you really switching your investment or diversifying your dollars from the S&P into the way more riskier GDX or GDXJ for that slight increase in return, I'd call? That's one of the problems we're looking at. That's the competition. Gold versus gold ETFs, and that's another thing. Like, okay, you should invest in ETFs. You want to have a lazy way because you got some leverage from the gold miners and mid-tier producers. But is it enough, again, to come out of the major blue chip companies that I've shown you before and just allocate your capital there? So gold and gold ETFs versus stock picking. So tough to read, so I've highlighted some of the numbers on the left, and I just picked out a couple. So if you were to do stock picking, and I don't advise picking just single stocks as a part of your strategy, but you can do probably way better than the index, because there are a couple dogs in those indexes as well, or indices as well, and picking those separate companies. I just picked out three that came top of my head, but Great Bears produced 207% last year. And that's way better than the 39%. And there are enough smart people out there you can talk to and listen to. Twitter has become a huge resource for me personally to find more information about companies and talk about companies. So gold versus the Orion index. So it's come a little more let's get a little more factual and what's happening. Is the market even responding to the gold price increase? We've peaked over $1,600 once. We're trading above $1,550 again, and there's been a bit of a discrepancy. Seasonality has kicked in, meaning we've seen quite a bit of flow-through financing, and the Orion index, because there have been larger bought deal finance, has peaked. As you can see, 1 week, that was the week of December 5th, I believe, we've seen a $60 million bought deal from Cisco Mining, raising $60 million in flow-through money. That's a massive spike. So our index, of course, is being diluted by those bigger, chunkier financings. But you can see there's a slight uptrend, but we're nowhere near where we should be. And unfortunately, I didn't put a chart in going back to 2011. That's when we started tracking the index in the industry, how seasonal it can be. And in 2016, we perfectly almost moved up in parallel with the gold price. While this year, and you can see it in this chart even better, is the financings haven't increased with the gold price. So investors, maybe gold price went up too fast, investors haven't caught up, but it's also, I think the other reasons is ETF competition, but also competition from the broad market, that there has been no need to reallocate capital into our sector, unfortunately. And that's about to change. And I'll come back to another slide where it's like, why is it changing? But the point I'm trying to make here, gold versus total sized open. Gold price went up. the trend continued to keep going down in terms of dollars raised. Yes, we've seen a couple of outliers, as I said, a $60 million financing by Cisco. There were a couple others. One financing I want to mention that we haven't put in there because it was too big is like Teranga raising $140 million for a transaction. So there has been activity, but it hasn't been nearly as constant as we needed or as overwhelming as it should be. One thing always as well, it has been Christmas season, so things probably were a bit slower. And one thing that has me quite positive, and we'll come to it on the next slide as well, is that the bought deals have started coming in already for this year. You remember this slide? I had it quite at the beginning. It's the total dollars raised. And one thing I just want to highlight here, interest is coming back. If you look at especially at the box at the top right corner, investors have come back come May. It was jump-started, fortunately, by a billionaire out of Toronto that put a lot of money into the market. He's close to $300 million by our count, investing into the junior space. And of course, a lot of investors followed him. He is a billionaire. He made his money in mining. Why not follow a billionaire into the sector, right? But unfortunately, his name also pops up, and you'll see that if you download the presentation, on the flow-through side with the negative premiums. So he's charging now companies by getting those discounts for his name and the volume and the credibility and everything he brings to the table. So be as it may, there might be companies with exceptions to it, but be wary of those negative premium flow-throughs, financings. So that's the chart I wanted to talk about as well. That has me quite positive, and it has been confirmed by companies to me as well. Bankers and brokers are back at the table. The phones have been ringing off the hook for some groups that bankers want to do financings. First week, we've seen 2 bought deals already for $33 million. It was Orion and Talisker Resources, and I might have forgotten the third one, but that's a fantastic sign. 2019, we had to wait until the end of February, right before PDAC, to see a first bought deal. That means bankers are way earlier at the table. My broker has confirmed to me, having dinner or lunch with him right before Christmas, that he's reaching out to his book again and making the efforts. He's making the trips to prime his contacts for potential financings down the road. He hasn't done that in 2.5, 3 years. And that's a really positive sign. And I'm sure he's not the only one who's priming his book right now for things to come. Total number of deals, that's more of a summary thing for last year. We've seen 1077, which is okay. We beat 2018, fortunately. For 2015, we beat. It's nothing crazy. We've seen a lot of small financings at year end. And fortunately, the overall average per month has increased once the gold price started increasing. Average deal size, which is a bit of a bummer actually, is that the only $2.3 million. It's quite low. It means there's still a lot of, I got to pay my accountant financings at the year end, and not much is happening with those financings. As you can see, over half of the financing, 600 out of 1077, have been financings below $1 million. That's not going to move the needle for a lot of companies. How can you save the industry? And I'm just playing here a little bit as well, just to give you a couple pointers. Even if you just allocate a small portion of your investments from ETFs into single stocks or participate in a placement, that would help the industry tremendously. Of course, it's getting more attractive. 1550, that point is almost mute now. But I should have pleaded the same thing last year. Just do that. It helps the industry tremendously. It doesn't help them if you put your money into passive funds or vehicles, because you can't create any shareholder value. Educate yourself. Join a stock club. There's so many good newsletters out there, conferences, you're all here, so that's a good start. Social media, as I said, Twitter has become a huge tool for me. Don't over-allocate, don't chase stocks. Azimuth went up 200% the other day. Don't chase it, wait till it settles. You can still make good money on that stock, I'm pretty sure. It looks a very good, interesting discovery. Avoid the financings I mentioned on the flow-through side, and start with prospectus financings. That takes out the 4-month hold. That makes it a little easier to trade. Quick outlook, I'm going to recap that next year as well. Flow-through financings will still remain important. Hopefully the market sees more common share financings, but for Canadian companies, flow-through will be the main vehicle to raise money. Access to financing will be troublesome still for the retail market. Join a stock club. And mid-tier producers I see coming back into the market, investing into exploration companies.